This is Mark to Market, a podcast of BT correspondents.
Hello, everybody. Welcome to Mark to Market, a BT correspondence podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of December 2025, and one of the biggest highlights of the recent reporting season was the surprising divergence in the financial performance of the three Singapore banks for the third quarter of this year. Specifically, I'm talking about United Overseas Bank, or UOB as it's commonly known, reporting a 72.5% decline in earnings for the quarter to $443 million as a result of a steep increase in provisions for non-performing loans. Now, it wasn't a particularly good quarter for UOB's two larger peers either, because of the persistent pressure of falling interest rates on net interest income, which is the biggest source of revenue for all three of the banks. In fact, DBS reported a 2.4% decline in earnings for the quarter to about $3 billion, while OCBC's earnings for the quarter edged up 0.2% to nearly $2 billion. But this was nevertheless way better than UOB's performance, and it was largely because DBS and OCBC did not report the same big jump in provisions for non-performing loans as UOB, and also partly because DBS and OCBC's revenue was more resilient than UOB's. Now, the market's immediate reaction to these financial numbers was quite stark. All three of the banks reported their third quarter results in the same week, and at the end of that week, UOB shares had fallen 2.3%, while DBS shares were up 2% and OCBC shares were up 4.4%. The Straits Times Index was up 1.4% that same week. If we zoom out a bit and look at their performance since the beginning of the year, up to roughly the middle of November, DBS has delivered a total return on a dividend reinvested basis of 31.3%, which is well ahead of the STI's total return of 25.5%. OCBC returned 16.9% on the same basis, which is not bad, but it's well behind DBS as well as the STI. Meanwhile, UOB's total return for the same period was close to zero. Now, I'm going to talk more about UOB's financial numbers and what they could mean for its stock, and offer some views on the outlook for DBS and OCBC later in this podcast. But let me first try to provide some context on what's happened to the three banks over the past few years, because it could help shed some light on all the moving parts of this story. Let me start with a fairly obvious observation. I think it's fair to say that the three banks are widely considered to be the bluest of Singapore's blue-chip stocks because they're big and they've delivered pretty good returns year after year. In fact, up until last year, the three banks had the highest market capitalizations among the 30 components of the Straits Times Index. Now, since then, Singtel has rebounded very strongly and it's leaped ahead of UOB. As of the middle of last month, which is when I collated these numbers, DBS had a market cap of $153 billion. OCBC had a market cap of $83 billion. Not far behind was Singtel at $80 billion. And then came UOB with a market cap of $56 billion. Now, these four stocks are quite a bit larger than all the other components of the STI. In fact, the fifth and sixth largest components of the STI, namely ST Engineering and Jardine Matheson, had market caps of about $26 billion each, which was less than half UOB's market cap. So the three banks and Singtel are sort of in a separate league within the Singapore market. Each of them is more than twice as large as the other components of the STI. Meanwhile, DBS is really in a class of its own. Its market cap is nearly twice as large as OCBC's and 3 times that of UOB. These market caps are a reflection of the growth the three banks have delivered over the years. During the 10-year period, up to roughly the middle of last month, the STI's total return on a dividend reinvested basis was 138%. DBS delivered a total return of 487% on the same basis. OCBC achieved a total return of 232%, about half of DBS, but still way better than the STI. Then there was UOB, which achieved a total return of 177% during the 10-year period. Not as good as its peers, but still better than the STI. Now, a good part of these returns were achieved over the last couple of years in the wake of a steep increase in profitability at all three of the banks. In 2022, As the COVID-19 pandemic waned and global economic activity restarted, there was a surge in inflation around the world, which led to a steep increase in interest rates as major central banks tightened monetary policy. This resulted in all three of the banks reporting a surge in net interest income, driven by a significant expansion in their net interest margins as their loans were repriced faster than their deposits. Now, for all three of the banks, net interest income is their most significant source of revenue, so this led to a big improvement in their overall profitability. For example, UOB reported a return on equity of 10.2% in 2021. By 2023, its ROE had increased to 13.4% before flattening out to 13.3% in 2024. OCBC's ROE followed a similar trajectory, rising from 9.6% in 2021 to 13.7% in 2023 as well as 2024. DBS already had a relatively high ROE in 2021 of 12.5%, and this rose to 18% in 2023 as well as 2024. But here's the interesting thing. In 2023, even as their earnings and ROEs were rising fast, the shares of all three banks didn't perform all that well. In fact, in calendar 2023, none of the three banks were among the 10 best performing STI counters. OCBC achieved a total return of 13.7%, which was better than the STI's total return of 4.7%, but that made it only the 11th best performer for the year. DBS returned 5.6%, while UOB returned minus 2.1%. The mood really shifted in 2024. Even though net interest margins at all three banks were normalizing at that point, their shares rose strongly. In 2024, DBS shares returned 52.3%, OCBC returned 36.5%, and UOB was not far behind with a total return of 35.2%. That made them, respectively, the second, fourth, and fifth best performing components of the STI for 2024. The STI itself returned 23.5% for the year. Since the beginning of this year, however, as net interest margins at the three banks have continued normalizing and as the surge in general provisions at UOB has ignited a lot of uncertainty, total returns from the three bank counters, as I mentioned earlier, have cooled and diverged, with only DBS beating the STI this year and UOB returning almost zero. So, how will the banks perform in 2026 and beyond? Should investors stick with the top performer DBS? Or does OCBC offer better value? Is it worth betting on a turnaround at UOB? I'm going to talk about that next.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Market, a podcast of BT correspondents.
One way to think about general provisions is that they are meant to cover anticipated but not yet specifically identified losses within a bank's loan portfolio. So when a bank makes large general provisions, it reduces its reported earnings in the immediate term, but it also means that possible future losses have been dealt with. And if those losses never materialize, it's possible that general provisions will be much lower in the future, or they may even be written back. This seemed to be the point that UOB's CEO Wee Ee Cheong made when the bank reported its results recently. He said the steep increase in preemptive general allowances that crushed its third quarter earnings were a very positive move, and he likened those general provisions to buying insurance in the face of growing macroeconomic uncertainties and emerging headwinds in certain sectors. Some analysts also suggested at the time that UOB was essentially bringing its accumulated provisions for bad loans in line with its peers, and that its rate of provisioning in future quarters would normalize. Certainly, the huge size of UOB's general and specific allowances in the third quarter of 2025 suggests it was taking a kitchen sink approach, so to speak. just one and done. UOB set aside more than $1.17 billion during the quarter, comprising $687 million of general allowances and $479 million of specific allowances. These are big numbers. If you look back to the third quarter of 2024, UOB had set aside only $296 million in specific allowances, and it reduced its general allowances by $15 million. With those big allowances that were made in the third quarter, UOB increased its non-performing asset coverage ratio to 100% and its unsecured NPA coverage ratio to 240%. Its general provisions on performing assets had been pushed up to 1%. These were quite substantial increases from the preceding quarter, that is, the second quarter of this year, when its NPA coverage ratio was 88%, while its unsecured NPA coverage ratio was 209%, and its general provision coverage on performing assets was 0.8%. So, why did the market react so negatively to UOB's third quarter results? Well, there were two big reasons, in my view. The first is that UOB showed clear signs of weakening asset quality. Notably, it reported $838 million of new non-performing assets in the third quarter. This compares to $472 million of new non-performing assets in the second quarter of this year and only $212 million in the third quarter of last year. UOB specifically said that it saw looming danger in the commercial property sector in Greater China and the United States. Even so, UOB's overall non-performing loan ratio at the end of the third quarter was only 1.6%, up from 1.5% at the end of last year. The other reason the market reacted poorly to UOB's third quarter results, in my view, was that its underlying business did not seem to be as strong as its peers. For the third quarter of 2025, its total income came in at $3.4 billion, marking an 11.4% fall against the third quarter of 2024. As I said before, softening interest rates and narrowing net interest margins were part of the problem. UOB's net interest income for the quarter fell 7.9% year-on-year to $2.27 billion, as its net interest margin fell 23 basis points to 1.82%. But DBS and OCBC were also affected by softening interest rates, and their top line seemed more resilient. For instance, OCBC's net interest income for the third quarter of 2025 fell 8.5% to $2.23 billion, as its net interest margin narrowed by 34 basis points to 1.84%. Yet its total income for the third quarter slipped less than 0.2% to nearly $3.8 billion due to robust non-interest income. Meanwhile, DBS managed to increase its total income for the third quarter by 3.1% to $5.9 billion, despite its group net interest margin contracting 15 basis points to 1.96%. Again, this was due to strong non-interest income. So, what should investors do? Well, if you want broad exposure to the Singapore market, it's hard to avoid the three banks. At the end of September, DBS alone had a weighting of nearly 26% in the STI. OCBC and UOB had weightings of nearly 13.5% and 10.8% respectively. Add them up and they account for more than half of the STI. The three banks also offer Singapore investors something they really love, which is high yields. While net interest margins at the three banks are contracting, their overall profitability is still quite elevated, and they have been returning billions of dollars in cash to their shareholders through higher dividends and share buybacks. In particular, DBS caused a stir late last year by announcing a $3 billion share buyback program. Not long after that, OCBC said it would return $2.5 billion of excess capital over 2 years through special dividends and share buybacks. Around the same time, UOB said it would return $3 billion over 3 years, comprising special dividends and a $2 billion share buyback program. Based on the dividends the three banks have already announced for 2025 and just extrapolating them to the end of the year, all three of them currently have dividend yields of more than 5%. The way I see it, all three of the banks are good long-term holdings for Singapore investors. However, they may not outperform the STI in the coming months, as narrowing net interest margins and the risk of deteriorating asset quality are likely to weigh on their profitability. Now, I know some analysts and investors are optimistic about non-interest income growth at the three banks, which encompasses everything from trading income to fees from credit cards and wealth management services. However, this segment of the bank's income tends to be volatile and hard to forecast, and some of these fee-related activities, such as private banking, could also be susceptible to competition over time. Now, among the three banks, DBS has performed most strongly recently, and it is trading at a relatively lofty 2.2 times book value. But DBS also has a relatively high ROE, which for the first 9 months of 2025 came in at 17%. On the other hand, OCBC is trading at about 1.4 times book value, and it had an ROE of 12.9% for the first 9 months of the year. UOB has the lowest price-to-book ratio at the moment of just 1.2 times. Its ROE for the first 9 months of 2025 was 9% because of the big dip in its third quarter earnings. In my view, DBS is likely to continue outperforming its peers despite its relatively high price-to-book valuation. Even in the face of narrowing net interest margins and the heightened risk of bad loans across the whole sector, DBS seems to have the strongest potential to deliver steadily higher dividend payouts over time. Moreover, as the largest component of the STI and the MSCI Singapore Index, it could also be a magnet for passive investment flows into the local market. On the other hand, OCBC is now in an interesting position. With all the concerns about UOB, OCBC may come to be viewed as the safest alternative to DBS and the main value play among the three Singapore banks. As for UOB, in my view, it may continue to lag behind its peers for some time. Even if its earnings rebound next year in the absence of further large provisions for bad loans, the bank may still face a lot of scrutiny from investors concerned about the resilience of its business. To win back the confidence of investors, UOB should perhaps begin communicating a clear and carefully thought-out strategy to transform its business and steadily lift its ROE over time. In other words, it should position itself as a value-up play in the Singapore market. This is easier said than done, of course, but it is arguably the story investors most want to hear right now. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Ben Paul. As always, thank you for listening, and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.